Impact of anticipated 50% increase in trade volume across key sectors by Q1 2025. Introduction. As we look ahead to Q1 2025, a significant transformation is predicted in the global economic landscape, particularly due to an anticipated 50% increase in trade volume across four pivotal sectors: transportation, telecommunications, energy, and agriculture. This surge is poised to reshape competitive dynamics, especially concerning U.S. investments in these industries. The following report delves into the implications of this increase, examining market dynamics, competitive pressures, technological advancements, and regulatory influences. Sector Overview. 1. Transportation. The transportation sector is navigating a challenging environment characterized by low freight rates and a significant shortage of drivers. Insurers are tightening underwriting standards in response to rising claims severity, with rates projected to increase by 8 to 10%. This tightening is particularly evident in states with high claim frequencies. The integration of telematics and other advanced technologies is incentivizing better risk management practices, offering potential competitive advantages to insurers who adapt swiftly. 2. Telecommunications. The telecommunications sector is at the forefront of growth, driven by an increasing demand for connectivity. However, companies must adapt their investment strategies to navigate evolving technologies and regulatory changes. The rise of 5G and increased data consumption are expected to drive substantial growth, yet companies must remain agile to maintain their competitive edge in a rapidly changing landscape. 3. Energy. The energy sector is grappling with conflicting signals. While demand is surging due to electrification trends and the growth of data centers, the political landscape introduces uncertainty regarding clean energy investments. The potential rollback of federal support for renewable energy initiatives could dampen investment flows, creating a precarious environment for companies relying on progressive energy policies. 4. Agriculture. Agriculture is poised for robust growth as trade volume increases, driven by technological advancements in farming practices and heightened export opportunities. However, climate-related risks remain a significant concern, with market volatility posing challenges to crop yields. The sector must address these risks through innovative practices and adaptive strategies to ensure sustainability amid changing environmental conditions. Common themes across sectors. Market dynamics and competition. All four sectors are witnessing increased competition, leading to the entry of new players and shifting market dynamics. Companies must stay vigilant and adaptable to navigate these changes effectively. Technological impact. Advanced technologies are reshaping risk profiles and operational efficiencies. From telematics in transportation to AI-driven systems in agriculture, the integration of technology is essential for staying competitive. Regulatory influences. The regulatory landscape is evolving rapidly, especially in the energy sector. Companies must stay informed and prepared to adapt to changes in federal policies that could impact their operations and profitability. Claims and social inflation. Rising claims costs due to social inflation are a concern across sectors, particularly in casualty and directors and officers D&O insurance. Companies must proactively manage these risks to maintain financial stability. Sector-specific insights. Transportation. The tightening of underwriting standards is leading to increased rates and a more challenging insurance landscape. Insurers are employing advanced data analytics to better evaluate risk and adjust pricing accordingly. Telecommunications. The sector is expected to see substantial growth, but companies must navigate regulatory hurdles and technological shifts to capitalize on new opportunities effectively. Energy. Despite a surge in demand, the political landscape poses challenges to investment in clean energy. Companies must remain agile and adapt to potential regulatory changes that could impact their operations. Agriculture. The anticipated increase in trade volume presents significant opportunities for growth, but climate-related risks must be managed effectively. Companies that adopt innovative practices will be better positioned to navigate these challenges. Conclusion: the anticipated 50% increase in trade volume across the transportation, telecommunications, energy, and agriculture sectors by Q1 2025 is set to reshape the competitive landscape markedly. Companies must adapt to evolving market dynamics, integrate advanced technologies, and remain vigilant of regulatory changes to capitalize on this growth. By addressing the challenges associated with rising claims costs and social inflation, businesses can position themselves for success in this rapidly changing environment. The interplay of these factors will significantly influence investment strategies and risk management practices moving forward, making it imperative for stakeholders to stay informed and prepared for the changes ahead. The anticipated 50% increase in trade volume across the sectors of transportation, telecommunications, energy, and agriculture by Q1 2025 is set to create a dramatic shift in competitive dynamics, particularly against U.S. investments. The insights from various sources reveal nuances and counterintuitive dynamics within these sectors that could reshape investment strategies and risk management practices. Counterintuitive insights. 1. Transportation sector challenges amid increased trade volume. The transportation sector is expected to benefit from increased trade volume, yet it faces severe challenges such as low freight rates and a persistent driver shortage. While increased demand typically drives prices up, the current environment suggests that even with higher trade volumes, the sector might struggle to maintain profitability due to these persistent operational challenges. 2. Telecommunications growth versus regulatory compliance. Though the telecommunications sector is poised for growth due to surging demand for connectivity, the rapid pace of change in technologies and regulatory environments creates a paradox. Companies might find themselves investing heavily in compliance and adaptation to new regulations, which could offset their potential gains from increased trade volume. This suggests that growth may not directly translate into profitability without careful management of regulatory risks. 3. Energy sector demand versus political uncertainty. The energy sector is experiencing a surge in demand driven by electrification and the growth of data centers. However, the political landscape introduces uncertainty with potential rollbacks of federal support and tax credits for clean energy initiatives. This creates a counterintuitive scenario where demand for energy increases but the conditions for investment may be less stable, leading to a cautious approach from investors who might otherwise capitalize on growing opportunities. 4. Agricultural opportunities versus climate risks. The agriculture sector anticipates robust trade volume increases, yet it is simultaneously vulnerable to climate-related risks that can impact crop yields. The counterintuitive aspect here is that while trade volume may increase due to a demand for agricultural products, actual profitability can be undermined by environmental factors, creating a scenario where higher volumes do not equate to higher margins. 5. Claims inflation and risk management. Across sectors, there is a rising concern about claims inflation driven by social inflation and nuclear verdicts, which is counterintuitive to the expectation that increased trade volume would lead to improved financial performance. Instead, companies might face higher claims and rising costs that could dilute their gains from increased business activity. This suggests that businesses need to invest more in risk management and claims handling to mitigate potential losses. 6. Insurance capacity and market dynamics. The anticipated increase in trade volume may lead to increased competition in the insurance market. However, the influx of new entrants and capacity could also mean that existing players will have to lower their prices to remain competitive, potentially leading to a race to the bottom in terms of pricing. This creates a paradox where increased competition does not guarantee better coverage or service, as insurers may cut corners to maintain margins. 7. Technological advancements versus underwriting challenges. While technological advancements are expected to enhance operational efficiencies across sectors, they also introduce new complexities in underwriting. Insurers face challenges in accurately assessing risks associated with emerging technologies, which can lead to coverage gaps, This counterintuitive outcome suggests that as sectors become more advanced, the risk landscape may also become more uncertain, requiring insurers to adapt rapidly. 8. Political landscape's role in energy investment. The energy sector's change in administration has introduced volatility in investment strategies. While an increase in trade volume could suggest a straightforward path for investment growth, political factors can create significant hurdles. This indicates that external factors such as government policy can overshadow market demand, leading to a complex interplay that investors must navigate. 9. Insurance market segmentation. The insurance market is witnessing a segmentation where certain sectors like cyber and healthcare are facing increased scrutiny and higher premiums due to claims activity. However, other sectors may experience a softening market. This divergence highlights that while some areas may see a rise due to increased risk, others may benefit from lower rates, creating a complex landscape for insurance buyers. 10. Emerging risks in environmental factors. As climate change continues to impact various sectors, the increasing frequency of natural disasters poses a counterintuitive risk. While sectors like agriculture may benefit from increased demand, they also face the threat of more severe weather events that can disrupt supply chains. Thus, the correlation between increased trade and environmental stability may not hold true, necessitating a shift in how companies approach risk management. Conclusion. The anticipated 50% increase in trade volume across these sectors heralds potential growth. However, the counterintuitive dynamics outlined above reveal complexities that could hinder direct benefits. Companies must navigate operational challenges, regulatory environments, and evolving risk landscapes to effectively capitalize on these opportunities, all while maintaining robust risk management practices to mitigate potential downsides. The interplay between increased trade volume and these multifaceted challenges underscores the necessity for strategic foresight in investment and operational decisions. The anticipated 50% increase in trade volume across the four sectors of transportation, telecommunications, energy, and agriculture by Q1 2025 presents a significant shift in the competitive landscape. While much of the analysis may focus on the expected growth and opportunities, several nuanced aspects of the report are likely to be overlooked, yet are crucial for stakeholders to understand. Key overlooked aspects. 1. Regulatory uncertainty and its impact. The report highlights the influence of regulatory changes, particularly in the energy sector. The change in U.S. administration has created an environment of uncertainty regarding tax credits and support for clean energy initiatives. This uncertainty could deter investments as companies may hesitate to commit capital without stable policies. Significance: regulatory frameworks are foundational for the sustainability of growth in these sectors. Stakeholders must actively engage in lobbying for stable policies and prepare for potential shifts that could impact their investment and strategic decisions. 2. Claims inflation and its wider consequences. Claims inflation, particularly in the context of social inflation and nuclear verdicts, affects underwriting practices and premiums across multiple sectors. The report notes rising claims costs due to social inflation, which can lead to stricter underwriting standards and higher premiums. Significance: this trend may not just affect insurance markets but could also influence operational costs for companies in these sectors. Higher operational costs may reduce profit margins and limit growth potential, making it essential for companies to implement robust risk management strategies. 3. Technological adaptation and its varied impact. The report touches on the importance of technology across sectors but does not explore the varying readiness and capability of different companies to adapt to these changes. For instance, investments in telematics and transportation are emphasized, yet the adaptation curve can vary significantly between large and small logistics companies. Significance: companies that lag in technological adaptation may find themselves at a competitive disadvantage. For stakeholders, Understanding the technological landscape and ensuring that their companies are not only adopting new technologies but also leveraging them efficiently is crucial to staying competitive. 4. Market dynamics in agriculture. While the anticipated trade volume increase in agriculture is noted, the impact of climate change and its effects on crop yields are mentioned but not deeply analyzed. Climate-related risks could introduce significant volatility in agricultural production and trade. Significance: stakeholders in the agriculture sector must proactively address climate risks through sustainable practices and innovative technologies to mitigate potential negative impacts on trade volumes and profitability. 5. Sector-specific competitive dynamics. The report mentions increased competition and new entrants across sectors but does not delve into how this dynamic may differ between sectors. For example, while telecommunications is poised for growth, the competitive landscape might be more favorable for new entrants compared to the more mature and potentially saturated transportation market. Significance: understanding the competitive dynamics specific to each sector will allow companies to tailor their strategies effectively. This can include identifying niche markets, potential partnerships, or areas where they can differentiate themselves from competitors. 6. Global trade relations. The report primarily focuses on U.S. market dynamics but overlooks the implications of international trade relations and policies. For instance, trade agreements or tensions can significantly impact sectors like agriculture and transportation, which are heavily influenced by global supply chains. Significance: stakeholders must consider the broader geopolitical landscape and its impact on trade volumes. Engaging with international partners and understanding global market trends will be crucial for navigating potential challenges and seizing opportunities. 7. Investment flows in family offices. Source 1 discusses family office investments primarily in Europe but does not connect how these investments may influence U.S. markets, especially in sectors expecting growth. Significance: as family offices look for diversification and stable returns, their investment decisions may shape the competitive landscape in the U.S. This could lead to increased funding for innovative startups or established companies within the transportation, telecommunications, energy, and agriculture sectors, which stakeholders should monitor closely. 8. Long-term sustainability versus short-term gains. The rush for growth may overshadow the need for sustainable practices, particularly in sectors like energy and agriculture. The report hints at the demand for clean energy but doesn't emphasize the importance of integrating sustainability into business models as a driver of long-term success. Significance: stakeholders must balance short-term growth strategies with long-term sustainability goals. Companies that prioritize sustainability are likely to be better positioned to thrive in an increasingly environmentally conscious market. Conclusion: the anticipated 50% increase in trade volume across the 4 key sectors presents both significant opportunities and potential challenges. Stakeholders must not only focus on the growth statistics but also consider the nuanced factors that will influence their strategic decisions. By paying attention to regulatory uncertainties, claims inflation, technological adaptation, climate risks, competitive dynamics, global trade relations, investment flows, and sustainability, companies can better navigate the evolving landscape and position themselves for success amidst the anticipated changes. 1. Market dynamics and competition. The anticipated 50% increase in trade volume across transportation, telecommunications, energy, and agriculture sectors highlights a significant shift in market dynamics. This surge will intensify competition, particularly impacting U.S. investments. For instance, the transportation sector faces challenges like low freight rates and a driver shortage, while emerging players are entering the market. As new participants increase competition, traditional players must adapt their strategies to maintain market share, potentially leading to pricing pressures and adjustments in service offerings. 2. Technological impact and adaptation. The integration of advanced technologies is pivotal in reshaping risk profiles and operational efficiencies across sectors. In transportation, telematics is being adopted to enhance safety and provide better pricing models. While the energy sector is leveraging technology for risk management concerning renewable sources and battery storage. The push for technological advancement not only improves operational outcomes but also influences how companies assess and manage risks, making technology investments a critical factor for success. 3. Regulatory influences and uncertainty. The political landscape, particularly changes in federal policy, is creating uncertainty across the energy sector. The potential rollback of tax credits and support for clean energy initiatives poses risks to investment flows and market stability. Understanding regulatory shifts will be crucial for stakeholders to navigate the evolving landscape effectively. This uncertainty may also impact investment decisions, as companies weigh the risks of engaging in sectors heavily influenced by government policy. 4. Claims costs and social inflation. Rising claims costs due to social inflation significantly impact the insurance landscape across all sectors. The increase in severity and frequency of claims, exacerbated by trends such as nuclear verdicts, affects underwriting practices, premiums, and overall risk management strategies. Insurers are compelled to adjust their offerings, potentially leading to stricter terms and conditions. As claims costs continue to escalate, companies must prioritize risk mitigation and effective claims management to navigate these challenges and maintain profitability. These points provide a comprehensive overview of the anticipated impacts of a 50% increase in trade volume across key sectors, emphasizing the interplay between competition, technology, regulation, and claims costs in shaping the future landscape. Here are 3 famous historical cases that reflect significant impacts on trade, investment, and competitive landscapes, akin to the anticipated changes outlined in your provided content. 1. The Smoot-Hawley Tariff Act 1930. This act was a significant piece of legislation in the United States that raised tariffs on numerous imports. The intent was to protect American industry during the Great Depression by making foreign goods more expensive, which would theoretically encourage domestic consumption. However, the act led to retaliatory tariffs from other countries, which significantly decreased international trade. The resulting decline in trade volume exacerbated the economic downturn, illustrating how regulatory decisions can reshape competitive landscapes and impact investment flows across sectors. 2. The North American Free Trade Agreement NAFTA 1994. NAFTA was a landmark trade agreement between the United States, Canada, and Mexico that aimed to eliminate trade barriers and encourage economic cooperation. The agreement resulted in a substantial increase in trade volume among the 3 countries, particularly in sectors such as agriculture, manufacturing, and telecommunications. The anticipated benefits included job creation and economic growth. However, it also faced criticism regarding job losses in certain U.S. industries. This case demonstrates how trade agreements can reshape competitive dynamics and investment strategies across multiple sectors. 3. The opening of China 1978. The economic reforms initiated by Deng Xiaoping marked a significant turning point for China's economy, transitioning from a closed command economy to a more market-oriented one. These reforms led to a massive increase in trade volume as China integrated into the global economy, attracting foreign investment in transforming sectors such as manufacturing, telecommunications, and energy. China's entry into the World Trade Organization (WTO) in 2001 further accelerated this trend. This historical case illustrates the profound effects that shifts in trade policies and economic strategies can have on global markets and competitive landscapes. These cases reflect the broader themes of trade volume increases, shifts in competitive landscapes, and the impact of regulatory changes on investment dynamics, similar to the anticipated developments in the sectors you've specified. The projected 50% increase in trade volume across the transportation, telecommunications, energy, and agriculture sectors by Q1 2025 is expected to have profound implications on the competitive landscape, particularly concerning U.S. investments in these industries. This surge is driven by several factors, including technological advancements, regulatory changes, and evolving consumer demands. Transportation sector outlook. The transportation sector is experiencing a dynamic shift influenced by economic pressures, low freight rates, and a continued driver shortage. Innovations such as telematics are becoming critical for improving operational efficiency and pricing strategies in insurance. The anticipated rise in trade volume is likely to enhance competition, prompting both established and new entrants to adapt quickly to changing market conditions. As underwriting standards tighten, we can expect premium rates to rise by 8 to 10%, particularly in states with high claim frequencies. Furthermore, advancements in technology will likely lead to better risk management, potentially benefiting those who invest in these innovations. Telecommunications sector outlook. In telecommunications, the growing demand for connectivity and digital services will fuel expansion. However, regulatory changes and the entry of new players could disrupt existing market dynamics. Companies will need to navigate these changes effectively to maintain their competitive edge. The anticipated increase in trade volume will likely attract significant investments, particularly in infrastructure development. To capitalize on these opportunities, firms will need to innovate continuously and adapt to regulatory shifts while focusing on customer engagement and satisfaction. Energy sector outlook. The energy sector is facing mixed signals as demand surges due to electrification and data center growth. While political uncertainties regarding clean energy investments could pose challenges, the Biden administration's supportive policies are under scrutiny, with the potential for shifts in federal support, particularly with the upcoming elections. The expected trade volume increase could lead to a greater focus on renewable energy sources, provided that investment flows are stable. Companies will need to remain agile, adapting to changes in policy and technology to navigate the evolving landscape effectively. Agriculture sector outlook. In agriculture, the anticipated trade increase is expected to be driven by robust export opportunities and advancements in farming technologies. However, market volatility tied to climate-related risks will remain a concern. As demands for sustainable practices grow, agricultural firms will need to adopt innovative techniques to enhance productivity while minimizing environmental impacts. This sector's ability to leverage technology and adapt to changing consumer preferences will be crucial for success. Common themes and predictions across sectors. 1. Increased competition. The influx of new players across all sectors will intensify competition, prompting established firms to innovate and differentiate themselves. 2. Technological integration. Technology will continue to reshape risk profiles and operational efficiencies. Sectors that embrace digital transformation will likely gain a competitive advantage. 3. Regulatory influence. Changes in regulations, especially in the energy and telecommunications sectors, will create both challenges and opportunities. Companies must remain vigilant and adaptable to shifting political landscapes. 4. Claims and underwriting pressures. Rising claims costs due to social inflation and increasing legal complexities will impact underwriting practices and premium rates across sectors. 5. Global supply chain impacts. The anticipated increase in trade volume will likely strain global supply chains, necessitating improved logistics and operational strategies within the transportation and agriculture sectors. Investment implications. Investors will need to assess opportunities within these sectors, critically focusing on companies that demonstrate resilience and adaptability. Sustainable practices, technological innovation, and strong risk management frameworks will be key indicators of future success. Conclusion. As we approach Q1 2025, the anticipated 50% increase in trade volume across these four critical sectors will not only reshape the competitive landscape but also redefine investment strategies and operational frameworks. Companies that can navigate the challenges and leverage the opportunities presented by this shift will likely emerge as leaders in their respective fields. The interplay of technology, regulation, and market dynamics will be vital in determining the success of investments and operational strategies moving forward.